We'll go straight into the next session, because after this session then we'll have a little bit more time then again to reflect on some of the key insights and lessons learned from this kind of, let's call it mini conference. Yeah? But again, I'm really excited about this session, and I'm very happy that my dear colleague and friend Didier has agreed to come and speak. As I said, he does a lot of work with families, with family offices, from an investment governance, investment strategy point of view. But on top of that, and even more so, he works with sovereign wealth funds and large investment groups around the world, where he helps them build investment machines and investment governance and investment strategy. And I think there is a lot that we in the family office, family enterprise world can actually learn from these behemoths of investment machines. So Didier, thank you so much for agreeing to be here, and a big round of applause.
Good evening, my friends. Such a great pleasure to be with you tonight. What a wonderful evening. And a wonderful evening that I would like to start maybe with a slightly damper note. I don't think there is anything like wealth preservation in our world. I think there is wealth creation or wealth destruction. But I don't think there is much in between. And I do believe that among the very sophisticated investors of today's world, the sovereign wealth funds are particularly interesting because of the evolution of the world. Not only the evolution of the world of investments, but the evolution of the world at large. We're going to a world of conflicts. Yes, geopolitical conflicts, but not only, right? Conflicts of values, conflicts of society, conflicts of interest. And the world of sovereign wealth fund is quite intriguing, and it's a world that family offices are a bit stuck into, but don't have the range of influence for value creation that sovereign wealth funds do. So what I would like to address together is governance in a deep way. I'm not going to talk about structures, etc. It's really governance in the sense of what performs, what brings to the right decisions in a world of transformed investments. We've been privileged to be engaged with around 15, these are formal engagement of 15 different sovereign wealth funds. They, of course, are a bit all around the world. Some, by the way, some are better than others. There is no question about that, and you can see it from their practices. And what I would like is to take the learnings I'm getting from them, from the investments, from the wealth creation side. So this is going to be really about the investment world and the wealth creation coming from it. And we all know what we think of as a sovereign wealth fund investment, something that's quite strategic, something that's quite privileged as well. These are the people that go and see Trump in his office, right, and come out with a nice deal afterwards, right? Or, you know, that cater somehow for the very powerful people of the world, right? And there is something also of impact, right? Because if we're thinking of the Singaporeans, for example, it's a diffuse impact of the standing of Singapore around in the world, where frankly a Temasek or a GIC have massively changed the Singaporean perception in the world, right? And we know what is great governance of investments at large, and that applies across investors and across asset owners, right? Having clear objectives. I really like how Abdullah spelled that out, by the way. And also the view of the family office as a business, right? As a wealth creation center per se. And how do you figure out your objectives there? But of course, notably in sovereign wealth fund, but in family offices as well, this is anchored in values and culture, what we stand for. It's also about projecting forward views, and it's having a top-down approach across asset classes. So this is a traditional perspective, but there are 4 radically evolving investment practices that I would like to address now. And these are the 4 that I would like to deepen, right? First, something that you probably have heard about, but I'd like to address it in a material way, which is what we call the total portfolio approach. Total portfolio approach, we also call it matrix allocation. The fact that classical asset allocation is threatened doesn't work very well anymore. And it doesn't work for several reasons. First, there are factors that are affecting investments that do not correspond to asset classes. You see, the concept itself of asset classes is bringing together investments that move in a correlated way, that move together. And the idea is an asset class is things that move together and differently from other asset classes. But geopolitics, for example, or technology, right, have affected across asset classes the movements. And so suddenly these asset classes can be highly correlated. We also see other factors. For example, if you think private credit, which has become an asset class per se, right? But a family private credit behaves very differently from a private equity private credit. And so the behaviors, even within an asset class, are quite differentiated. So people are moving away from these asset classes. You can see, for example, the future fund as a leader on that. CalPERS is talking about it. And frankly, more and more of the sovereign wealth funds are addressing, how to move out of asset classes, not to think in asset classes anymore. Interesting, the way the asset management industry is structured is asset classes. And that's probably a value-destructive proposition for the future. The second point I'd like to come to is dynamic rebalancing. How do you move with the world? We have a world that's massively changing, right? How do you move with that? Again, future fund, quite interesting, that move into gold, away from the dollar, and into AI, and into Australian-based assets, right? So how do you rebalance your overall portfolio? Then the third dimension that's intriguing is governance, but governance engagement. Governance engagement across the system, including within your assets, being active within your assets, not being passive as an investor, and thus moving also with other actors, including the fund managers, being proactive there, passive investing, being less favored in the world of wealth creation by sovereign wealth funds. And the fourth trend that I want to get to is, of course, the rise of private assets, but more and more through direct investments. And the fact that, for example, I just came from Tokyo this morning. By the way, interesting, sovereign wealth funds are being created everywhere in the world. The US are not quite managing their creation, so it's going to be within DFC. But Japan is creating a sovereign wealth fund right now, and they're thinking about it, they're elaborating it, etc. And so these large actors, right, national actors, are becoming transformative. And within Japan, you see that movement to direct investment. JPIF, it's a pension fund, $1.7 trillion, one of the largest actors in the world, has been studying, if you want, the performance of private equity across firms, and concluded, what do you think they concluded? It does not create value. It does not create value when you consider the fees accumulated. And so where do you go in a world of private assets? Because we are in a world of private assets. And how do you access the right deals? So we live in a new investment world order, right? More conflicts, more interventions. And it made me think a lot because I was educated by the Nobel Prize winners in finance, of efficient markets, etc., right? But it made me think about that, right? When you think about it, Silicon Valley, pure competitive world, right? Not quite. Financed by defense in the US from the very start. Hewlett-Packard was started originally on defense contracts. The pharmaceutical industry, highly competitive, right? Not quite. Subsidized by university research that they get for really cheap. And so we see some of the most profitable industries of the world that are actually highly subsidized by states. And the question of, okay, how do you invest into the new trends? We also see more divergence, more distance between the haves and have-nots, right? And what is this going to create from an investment perspective? We see more drivers of returns. The geopolitics, climate change, demography, technology, of course, but also connectivity, networks, and privileged access. We see more volatility, but also more fragility in the market. And certainly more uncertainty, as Francois has mentioned earlier. Which means that more and more of the sovereign wealth funds are fostering long-term relations, almost friendships, across countries, across actors, to invest together. And so within that, they do with sophistication. I'm showing you here a total fund optimization with club deals, with direct investments, with matrix allocation, with very specific type of asset classes that are much beyond. I'm also showing you the performance of governance involvement. A quick picture, right, of the most best governed in the US. In the middle, very light, the S&P 500 and the 100 worst governed in the US. And very interesting how governance add on average 4% of performance. If you go for the 100 best governed versus the 100 worst governed versus the middle. But it's also interesting that you create much different risk, much different transformation of the distribution. Basically higher Sharpe ratios, lower drawdowns, lower downside volatility. I don't want to be too technical, but governance is transforming your risks. That's why you see now sovereign wealth funds investing hundreds of millions in governance itself. Governance of the assets that they're investing in or that they own. And then we are seeing that world of private, where we see a significant increase in allocation to private markets, but there is a lot of zombie funds out there. By the way, if you look at secondary value on the secondary markets, right, it's terrible. I see some actors that when they value their private equity fund in the secondary market, we're dropping at 70%, 60% of the value of what they think they have. And so you're seeing a risk in these private assets that is underestimated today. And so how do we go with private assets? More and more people are moving to direct, to choosing, maybe with a GP, a co-investment, or simply bringing together large actors of relationships to figure out the best deals together. One originates a deal, another one originates another deal. And so there is concentration along fewer GPs. There is a deployment of larger dollars, typically with lower fees. And I've given you some of the GCC examples. I find ADQ particularly interesting. ADQ is the latest generation of sovereign wealth funds, right? It was created almost as development for Abu Dhabi. ADQ a year ago was $250 billion. Do you know where it's going to be at the end of this year in terms of value creation? Not quite, but they added 50 billion in a year. They're going to be at 300 billion from 250 billion in 1 year. And it's interesting because they're playing ecosystems and they're playing direct investments. So they're playing direct investments in a very sharp way, which is what I see around. The rise of club deal with that will to develop bilateral relations right across countries that are somewhat aligned. And the interest in figuring out ecosystems whereby you create value in multiple dimensions. And so there is a move of the efficient frontier, if you want, with club deals that we are seeing today. And there is too much material for me to go in depth, but I would like to take one theme, sovereign security, a modern theme of investments, which of course is critical for sovereign wealth fund at large. This is an analysis, right? And you're seeing some themes like critical resource control. I'm seeing absolutely amazing deals that are hugely value creative, for example, on critical minerals these days, right? Deglobalization, again, some very interesting deals, think Panama Canal, right? Or digitalization, as we've addressed before, autonomous and unmanned systems. I thought I would give you a few examples. ICEYE, satellite company with radars that sees through anything. So any weather, usually satellite needs certain clarity of weather to be able to actually analyze what's on the ground, right? This company, Finnish company, seeded by the Sovereign Wealth Fund of Finland, in just a few years has become a multi-billion-dollar value. Multi-billion-dollar value. Giving you another example with the port of Subic. I'm going to be short on time, so I'm not going in there. Cerberus is a private equity firm that was founded by Steven Feinberg, today number 2 of the Pentagon, right? And again, very strategic, a lot of value creation behind. I'm not going to go into the detail. I'm going with something a bit younger, with Skylabs, also on the satellite side, but this time with communication, or with LNG on the West Coast, the prices of gas in the US. We have, all the value of gas in Asia. We have seen the success of Qatar over the long term at playing that market, and the will of the US and Canada to disrupt that market like they have done with oil. And so this is very intriguing, right? The world of investments has transformed. It's transforming and it's keeping transforming. I think the legacy financial theories that have been taught in business schools like ours have grown obsolete. Sovereign wealth funds show a path that can inspire many. We have portfolio optimization, rebalancing, and governance that need particular attention for wealth creation. And I'm very intrigued by what I see from direct investments that offer exceptional opportunities for the few privileged that can access them. And I think we are in a world of privileged access. By the way, it comes with a world of conflict. It comes with a world of distance, of separation, of haves and have-nots, right? But that world of privileged access needs to be leveraged into wealth creation of family offices as well, in my view. Thank you very much.
Didier, maybe, I think we would have time for maybe one or two short questions. Show of hands, any short questions you would like to throw at Didier right now? Otherwise, he will also be, oh yeah, there's one, thank you.
Thank you so much. I found that so interesting. This is a room that's actually quite familiar with the creation of value through private companies. These are mostly families that have built, a very significant amount of wealth through private equity. As an industry, as an asset class, private equity general partners have typically not performed at that level. Is there a structural reason why that would be? Is there something that's fundamental about the general partner, limited partner relationship that is creating less value than what these families have created? And if you frame your response around direct investment, around club deals or minimization of fees, are you just rationalizing around a structure that hasn't worked as well as what has worked in this room?
Wonderful. It's a wonderful question. And it's, in my view, stems in a very simple answer, which is the self-interest of the asset management industry at large. And the fact that it's enclosed into its structures, right? And it's just feeding itself, not serving the clients. And by the way, it is true of the whole asset management industry, not only of private equity. Which means, again, right, that in private equity, you have a few of the funds, not a few firms, but a few funds, right, that do well. And if you have access to these, you're fine, right? But it is, again, a privileged access. It is, again, a relationship game. So we have moved away from a standard of performance that is for all. And it's very, very intriguing, right? How do you move away from that? But I also love the point that there is a lot of experience in wealth creation in family offices, direct and indirect, right? And the question is, how do you lever that in other assets? How do you keep that mind? How do you don't create something completely separated? By the way, the best sovereign wealth funds, contrarily to what people could think, are not separated from government. They work in harmony with government, with an investment mind, with wealth creation, right? But they work with connectivity, understanding, right, with the objectives and figuring out where this can land into good investments. So I do believe that there are ecosystems, for example, that you can figure out. I think in the investment world, ecosystems will become, the connectivities of wealth creation. For example, in Japan, I work with a gentleman, young man, very talented on the investment side, who's is doing, depending on the side you look at, social investment or distressed real estate. He basically, buying cheap real estate, reviving the whole area, right? Creating shops, creating attractivity, etc., and selling the real estate at 3-4 times the price he got them for, right? And you have people, that are figuring out ecosystem. Abu Dhabi is exceptional at figuring out their, for example, they created a crypto bank, right? But with that crypto bank, they immediately made payment possible to Etihad, to their supermarket chains, right? And they're figuring out all the system of value creation that can support the wealth of each of their investments. So it's very, very intriguing. How do you play that as a family office? And it comes back to an element that Peter and Alexis presented before, the identity of the family office, right? And how do you lever that identity even more precisely, maybe that the archetypes they give you, right? To actually create wealth from that identity. Thank you.
Wonderful. Thank you very much, Didier.